Warm welcome to this video of CA Raja classes. In this video, we are going to talk about the most sensational topic, that is Prudential framework for income recognition, asset classification and provisioning pertaining to the projects that are under implementation. Actually, this is a draft framework issued by Reserve Bank of India on 3rd May 2024. And this is applicable for the projects that are under implementation only. It means in general for loans and advances, there is a prudential framework which deals with IRAC norms, but this area requires a special attention, that is the projects under implementation requires a special attention. So in that context, Reserve Bank has released this framework. It is still in its draft stage. After going through the public responses, it may be either adopted without any modifications or with modification. That's something which we have to wait and see. For whom this framework is applicable? This is applicable for commercial banks, NBFCs, urban cooperative banks, all India financial institutions who are going to assume or who have assumed project finance exposure. It means they are going to give loans for project purposes. And for what projects? For infrastructure projects, non-infra projects and commercial real estates. So if a bank or NBFC or UCB or All India Financial Institution, if they are going to give loans for project, then this framework is applicable. And this draft framework also has regulatory dispensations when it comes to changes in DCCO. That is, if there is going to be a change in date of commencement of commercial operations of the project, then what are the regulatory dispensations? So the revised one, everything is brought out in this framework. So this framework is basically a 20 pages document released by Reserve Bank, and you will find the document next to this lecture. If you are watching it in YouTube, you may find the link, okay, in description. So this document talks about various aspects and I have taken efforts to cover everything. At first, the document talks about the phases of the projects. As you know, this framework is for projects under implementation, so it is very important to understand the phases of projects. There are 3 phases, okay. The first phase is called as a design phase. So it is in this phase the project will be conceived, a design will be made for, planning will be done, various approvals, clearances will be obtained, and sanctions from loan will also be taken. So this is a stage up to financial closure. So the project is conceived, all the approvals are obtained, and even the financial closure is done at this stage. When I say financial closure, it means the lenders for the project and equity investors all are identified, and what is the amount they have to contribute, everything is finalized and freezed. So this is phase 1. Then comes the phase 2, which is called as construction phase, and this phase starts after the financial closure. It means the loan sanctions are obtained, so the loan amount is going to be drawn, and using which the construction is going to happen. The promoters are also going to bring in their money, the construction is going to happen. So it begins after the financial closure, and it will continue and it will end a day before DCCO, that is a date of commencement of commercial operations. So construction phase starts with end of financial closure and it will end a day before DCCO. It means on the date of commencement of commercial operations, things are going to roll on, and with that comes the last phase, which is the operational phase. So it starts with commencement of commercial operations. Okay, so let's have a basic idea of the phase. This framework prescribes prudential conditions for project finance. What are they? Number 1, it says there should be a board approved policy in place if the lenders are going to give loan for project finance purposes. That is, if the lenders are going to assume project finance exposure, then they should have board approved policy. Board approved policy for what? Board approved policy for resolving the stress in projects which are going to arise on occurrence of credit event. So if a credit event takes place, then there is a stress in the project. So that stress have to be resolved, and for that there should be a policy in place which should have been approved by the board. So this is the prescription number 1. So now we have to understand few things here. We said on occurrence of credit event. So we need a clarity on what is credit event. Credit event means a default has taken place. Default means what? Non-payment of debt. This is actually defined in insolvency and bankruptcy code. Okay. So either whole of the debt or part of the debt or installment which has become due and payable is not paid by the debtor, that is the borrower. If that is happening, then there is a default. But a mere default will not be construed as credit event. There is a default, and because of the default, the lenders, having analyzed the situation, they come to a conclusion that there is a need for extending the original DCCO. So already date of commencement of commercial operations is finalized. But when the default have happened, banks have studied the situation and they understood that something is seriously wrong. So DCCO have to be extended. Or let's say the DCCO was already amended and now they feel that it has to be extended even further. That is subsequent extension of already amended DCCO. Or the banker feel that, the lenders feel that this project requires even more additional debt. With the present level of debt, it cannot proceed further. So if the lenders is going to decide the need for extending the original DCCO or subsequent extension of already amended DCCO, or if they feel that there should be an infusion of additional debt, then if any of these happens, then we can say that gives rise to credit event. So when it gives rise to credit event, what is happening? It is an indication of stress. Then that stress have to be resolved, and for that there should be policy in place which should have been approved by the board. So the cycle goes like this. So this is only one aspect. The other aspect is there is a default, and because of the default, the lenders study what is the net present value position of the project. So originally at the time of the sanction, they would have seen what is the net present value. Now because of the default, they are checking the NPV once again, and when they check that, they are identifying that there is a diminution in net present value of the project. So original NPV has come down. Original NPV has come down. There is a diminution. So this will also be construed as credit event. See, understand here there is no need for changing the DCCO. Okay, the bankers have not considered the need for extending the original DCCO. They are not extending the already amended. They are not looking into the aspect of infusing additional debt. But they are checking the NPV, and NPV has come down. It means this is also considered as credit event, and credit event, if it is found, then there is a stress in the project. Then that got to be resolved as per board approved policy. Okay, so this is prescription 1. So here we talked about two critical items. One is DCCO, the other one is net present value. Let me throw some light on this. What do we mean by DCCO? DCCO stands for date of commencement of commercial operations. So this is basically the date by which project is expected to put to commercial use, and it is on this date the completion certificate or provisional completion certificate is issued to the concessionaire. And if you take the CRE projects, this DCCO date will be the date on which occupancy certificate will be issued by the competent authority, or the date on which occupancy certificate is obtained from the competent authority. Okay, that is DCCO. Let us also understand what is NPV, because the diminution in NPV is paving way for what? Credit event. And that is going to have lot many consequences. So we have to understand what is NPV, net present value. This is actually one of the method used to find the real value of the project. It is one of the method used in capital budgeting. Let's say for example, the project demands an investment of 1000 crore now. So this 1000 crore is invested now. And this 1000 crore is going to generate, let's say, 100 crore for next 20 years. For next 20 years. That is, it is going to generate 100 into 20, that is 2000 crore. But this 2000 crore is generated over a period of 20 years. And I want to know what is the present value of this 2000 crore. So what I will do, I will find out the present value of this 2000 crore by discounting it at my cost of capital. And if the present value of 2000 crore, if it is going to be greater than 1000 crore, because 1000 crore is the money invested now in the project. If the present value of 2000 crore is going to be greater than the invested amount of 1000 crore, let's say for example, hypothetical scenario, let's say this 2000 crore present value works out to 1050 crore. Then what that means, the actual value or worth of the project is 1050 crore, for which I am investing only 1000 crore. So there is a net gain of 50 crore. That's what we call as net present value. Okay. So I just took a very hypothetical number because 2000 crore, 20 years, if you discount now and if you find the present value, it will not be 1050 crore in real scenario, because the present value will vary according to the cost of capital you are going to use for discounting purposes. So unless and until you use very thin rate, very small rate, getting that amount is also very difficult. But I said it's a hypothetical scenario. So what is happening here? I'm comparing the investment of 1000 crore now with the present value of the future cash flows, that is 1050, and now I'm coming to a conclusion, this project is 50 crore worth more. I'm investing only 1000 crore, but its actual present worth is 1050. So I'm getting a positive benefit. It means I'm getting a positive net present value. So let me go ahead with the project. So look at the process. In NPV, we will ascertain the future cash flows. We will discount it at cost of capital. We will find the present value of those future cash flows. Then what we will do, we will compare the present value of the future cash flows with present value of investment. So when I do that, what I do, I take PV of inflows minus PV of investment. If I'm going to get the value as positive number, then we say it is a positive net present value. It means that project is adding more value. So the project will be selected. And if you are going to get it as a negative figure, then ideally the project should be rejected. Let's say for example, I am investing 1000 crore and I am looking at the present value of the future cash flows and it is only 850 crore. It means I am investing 1000 crore on a project which is worth only 850 crore. It means I am losing 150 crore. And how I am getting this? I am comparing the present value of inflows, which is 850 crore. I compared with the initial investment of 1000 crore. So there is a loss of 150 crore, which is negative. So I should reject the project. So this framework mandates that if a bank is funding a project, they should look into net present value and they should ensure the net present value is positive at the time of sanctioning the loan. And if there is going to be a default, that is the borrower is not paying the amount due on time, then bank should recalculate independently, re-evaluate the net present value and they should ensure it is at the same level. If there is going to be a diminution in NPV, even in positive zone itself, but if there is going to be a diminution, then that is a credit event scenario. Okay, so this understanding is very, very important. So look at here, positive NPV is a prerequisite, and during the construction phase, why NPV should undergo a change? What could be the reason? See, what are the influencing factors of NPV? NPV is basically present value of future cash inflows, which is compared with the present value of investment, right? So if there is going to be changes in the future cash inflows, or if there is going to be change in the life of this future itself, or if there is going to be change in any other factor, then that can have impact. So that's what mentioned here. The diminution during the construction phase can arise because of the projected cash flows, changes in projected cash flows, changes in the project life period, or any other factor which can lead to credit impairment. Then this diminution is going to be counted as what? Credit event. And what is the consequence? Bank should re-evaluate NPV every year independently. Okay, if there is a diminution, then it's a credit event. Then there is a stress. That stress have to be resolved. For that, a resolution plan is required that got to be implemented. So many things will follow. Okay, next, the framework also talks about mandatory prerequisites. That is, if a bank is going to finance a project, they have to ensure all mandatory prerequisites are in place before the financial closure. Okay, it means they should not just like that sanction a loan in a hurry and say that all the conditions have to be complied after the loan sanction by giving certain timelines. No. All mandatory prerequisites should be in place before financial closure. So we need a clarity on what do we mean by financial closure. So that is also defined. Financial closure means a date on which a minimum 90% of the project cost funding is arranged through debt and equity. I repeat, a minimum 90% of the project cost funding is arranged through debt and equity. It means those funding are legally binding on all the stakeholders. That is, debt means bank should have agreed. Equity means owners, promoters should have agreed. And all approvals, all clearances that are required for implementing or constructing the project should have been obtained. So a date on which all these are obtained, we say on that date financial closure is achieved. It means all mandatory prerequisites should come before this particular date. So what are the prerequisites which are touched in the framework itself? Framework gives you an indicative list. It says for projects, requirements like having an encumbrance free land, right of way, environmental clearance, legal clearance, regulatory clearance, everything should be in place. And if it is an infrastructure project, then land availability at least to the extent of 50% can be considered as sufficient by the lenders. Next, the framework talks about disbursement of funds. It makes it very clear that DCCO have to be spelled out and documented and financial closure achieved before disbursement. So without ensuring financial closure, without ensuring documentation of DCCO, banks should not disburse funds. And when they disburse funds, they have to do it on proportionate basis only. That is, for every stage of completion, a certain amount can be disbursed. This has to be prescribed in advance. And it should not just be linked with the stage of completion, it should also be linked with the progress of equity infusion, because for every tranche of disbursement, there should be simultaneous or upfront contribution of the margin by the promoters in the form of equity or as agreed. So disbursement should be proportionate with the stage of completion and with the progress of equity infusion. And if you take PPP projects, that is public-private partnership projects, the disbursements should begin only after the declaration of appointed date of the project. So what do we mean by appointed date? It is the date that is defined in the concession agreement between the concessionaire and concession granting authority. So this is basically applicable for infra projects that are coming under PPP model. And the framework also makes it clear that lenders have to give the disbursement schedule vis-a-vis the stage of completion. This is something I mentioned earlier also, right? So for every tranche of disbursement, what should be the stage of completion? This has to be prescribed by the lenders itself. And this stage of completion have to be verified by the lender's independent engineer or architect, and they have to certify the same. And in case of PPP projects, we said disbursement of funds can happen only after declaration of appointed date. So the DCCO, which is documented in financial closure document, it can be modified to reflect the change in appointed date by the concession authority. This has to be done prior to disbursement of funds, and for that a supplementary agreement can be created between the lender and sponsor. But here the condition is there should be reassessment of project viability and sanction should be obtained from appropriate authorities for this. Next, the framework talks about projects that are financed under consortium arrangement. It says under consortium arrangement, if the aggregate exposure is 1,500 crore, then the share of individual lender in the consortium should be at least 10% of the aggregate exposure. So the expectation is each lender should have at least 150 crore. And if the aggregate exposure is greater than 1,500 crore, then the share of the individual lender in the consortium should be either 5% of the aggregate exposure or rupees 150 crore, whichever is higher. This is basically done to spread out the risk among the participants in the consortium. Next, it talks about loan repayment tenure, and it also touches on the moratorium. It says no moratorium should be given beyond DCCO. Beyond date of commencement of commercial operations, no moratorium. If at all it is given, then it should be within 6 months from DCCO. So the maximum moratorium is only 6 months. And it also prescribes something about the repayment tenor. Whether the original tenor or the revised tenor, whatever it be, it should be within 85% of the project life period. So if the project life, let's say, is only 10 years, then the tenor will be only 8.5 years. Then in chapter 3, it talks about the resolution and prudential norms. Already we said there should be board approved policy to resolve the stress that are going to arise on account of credit event. So for this purpose, the lenders should continuously monitor the project implementation to see whether there is any buildup of stress. And when they identify that, they have to initiate something known as resolution plan, and this should happen well in advance. So what is important here is the occurrence of credit event, and this credit event, if it occurs even with any lender in the construction phase, let it be within the consortium or outside the consortium, if it occurs with any lender, then that should trigger collective resolution. And this credit event have to be reported by the concerned lender to Central Repository of Information on Large Credit, we say CRILC. They should send the weekly report as well as main report, and when they are part of consortium or MBA, then they should report this credit event to other members as well. So those members should review their debtor account because they are also having exposure, right? They should review the debtor account within 30 days of the credit event. This is very important. So in this period, the other agreements can arise like inter-creditors agreement, implementation of resolution plan, and all those have to be as per the provisions of Prudential framework. Then the framework talks about resolution plan involving extension of DCCO. Let's say the stress has been identified and a resolution plan is framed, and this is resulting in change in DCCO. So a resolution plan involving change in DCCO can be implemented only if the conditions what we are going to discuss are met with. The first condition is all the required documentation, say like executing the necessary agreements between the lenders and debtors, creation of the security or charge, perfection of securities, everything have to be completed. Number 2, the new capital structure or the financing arrangement should get duly reflected in the books of the lender and the debtor. Okay, only then the resolution plan involving the extension of DCCO will be deemed to be implemented. Else, next, the framework talks about account classification, and this is very important. Let's say a project finance exposure is at present classified as standard, and now there is an extension of DCCO, and as a result there is a shift in the repayment schedule as well, let's say for an equal period or a shorter duration. In these conditions, what will be the treatment of that project finance exposure? Will it continue as standard or will it be downgraded? For that, the treatment is provided in the framework. It says those accounts can continue as standard if certain conditions are met. What are they? See, because of this resolution plan, there is a DCCO extension, right? If this DCCO extension is arising because of exogenous risk, so we may have a question, what is exogenous risk? And I've also mentioned about endogenous risk. So we may have this question that I'll address shortly. But understand this, if the DCCO extension is arising because of exogenous risk, then up to 1 year that exposure can be continued as standard. And this is applicable even for CRE project exposures. Okay. So if it is on account of exogenous risk, up to 1 year it can be classified as standard. And if it is on account of endogenous risk, then if it is an infra project, then for up to 2 years it can be continued as standard. And if it is non-infra project excluding CRE, then for up to 1 year it can be continued as standard. And the third category is litigation, that is court cases. In those cases, up to 1 year including the CRE projects, it can be continued as standard. So let's clarify what is exogenous risk and endogenous risk. Exogenous risk means these are all the risks that originate from outside. It may be on account of natural calamities or pandemic or change in government policy or regulation or law. These risks will adversely impact and it will give rise to the project cost overrun, time overrun. So who will get affected because of exogenous risk? Maybe some entities or most entities in the economy or specific sector or specific geography. That is exogenous risk. And what we have understood, if the DCCO extension is arising on account of exogenous risk, then what is the time period? It is up to 1 year. Then there is something known as endogenous risk. This is arising on account of reasons that are internal to the project. So they may arise on account of deficiencies in planning the project or execution capabilities. And these kind of risk will also lead to cost overrun, time overrun or change in ownership itself. And in case of endogenous risk, what is the extension benefit available? It is up to 2 years for infra project and 1 year for non-infra project. And what will happen if both are going to materialize together? That is, both exogenous and endogenous risk are going to materialize together. In those cases, the longer of the permissible deferment can be availed. So, the cumulative deferment, the maximum what can be taken is 3 years for infra and 2 years for non-infra. But if the extension is going to go beyond these permissible period, that is extension beyond this limit, then in that case, the standard asset classification will not continue, would not qualify for asset classification dispensation. So it will not be classified as standard, it will be downgraded as substandard. Next, the framework also touches on another important area, that is the retention of standard asset classification. So it talks about scenario where there is a change in repayment schedule because of increase in project outlay that is arising on account of increase in scope and size of the project. Okay, so there was an original project for which loan was given. Then the project scope increased, the project size increased. So as a result, what is happening? There is an increase in project outlay, and because of that there is a change in repayment schedule. In those cases, how the treatment is going to be? Let's see. In those cases, standard account status can be retained if the increase in the scope and size of the project is happening before the commencement of commercial operations of the project itself. So look at here, the increase in what? The scope and size, that is happening before the commencement of commercial operations itself. Look at this, number 2. There is a rise in project cost, and this rise is greater than or equal to 25% of the original outlay. In that case also, standard account can be maintained. And third scenario, here the lender reassess the viability of the project, and they are doing this before approving the enhancement of scope and fixing the fresh date of commencement of commercial operations. In that case also, standard account can be retained. And situation 4 is connected with rating. Let's say the project is already rated and now a new rating is been obtained, and this new rating is not below by more than 1 notch, then yes. Or let's say in the past the project is not yet rated, but now there is an increase in scope and size, and now the project is rated, and when it is rated, it is at the investment grade level, then the standard account can be retained. See here, with reference to this particular parameter, 2 examples are provided in the framework. I will cover that also. So understand, here we are talking about retention of standard asset classification that is arising on account of change in the project outlay, which is mainly on account of increase in scope and size of the project. Look at this example. The original cost of the project is 1000 crore, and now that has increased and the revised cost is 1200 crore. So what is the increase here? Increase is 200 crore. And if we further analyze the reason for increase, which is basically 20% increase from the original level, only 18% increase is on account of change in the scope of the project, and remaining 2% is on account of cost overrun. So here we have to understand one thing. Probably I missed out here. Here I should have mentioned rise in project cost excluding any cost overrun. We cannot take cost overrun as a factor for retaining the standard account classification. So coming back here, there is a 20% increase, and of this 18% increase is on account of change in the scope of the project, and only 2% is on account of cost overrun. In this case, whether this project is eligible for retaining the standard asset classification, let's see. This condition says the rise in cost of project is 25% or more of original outlay excluding cost overrun. It means the main reason should be change in scope. So on account of change in scope, if the increase is greater than or equal to 25%, then this rise in project cost is eligible for retaining standard account classification. So here the increase is only 18%. So increase in cost on account of change in scope is 18%, which is below 25%. So standard asset classification benefit is not available. Let's take one more example. Original cost of the project is 1000 crore, revised cost is 1400 crore. So there is an increase of 400 crore, which is 40% increase. And when we further analyze, we understand that out of 40%, 30% increase is on account of change in scope of the project, and 10% is on account of cost overrun. So the increase in cost here is on account of change in scope as well as cost overrun, and change in scope itself is 30% contributory. And for retaining the standard account classification, what is the minimum change that is required? 25%. So in this case, standard asset classification benefit is available. And there is one more point. This benefit of standard asset classification, which is going to arise on account of change in the repayment schedule, can be availed only once in the lifetime of the project. Next, there is something known as SBCF that is also discussed. That is standby line of credit facility. See, at times banks will also be sanctioning this SBCF at the time of financial closure. They basically give this to fund the cost overruns which can arise on account of extension of DCCO. If that is sanctioned, then funding up to 10% of the original cost can be provided. This is prescribed in the framework. Let's say it is not sanctioned, or for some reason it is sanctioned and not renewed. Then banks can, or the lending institutions can, fund the cost overrun which are going to arise on account of extension of DCCO up to 10% of the original project cost. Here the interest during construction have to be excluded while doing this. But the point here, or the condition here, is when it is not done and when it is sanctioned, it should be at a premium pricing. Okay, it should be at a premium pricing, and the floor premium is capped at 1%, and this premium pricing benefit for the lending institutions is available only for the infra projects. Once the lending institutions implement the resolution plan, they should ensure the financial parameters, the critical parameters like DSCR, debt service coverage ratio, debt equity ratio, and external rating, all remain unchanged. They should be either unchanged or they should be enhanced in favor of lenders. What will happen if the resolution plan is not implemented within 180 days from the end of review period? Then in those cases, that account will be downgraded as NPA. So if they have to be upgraded, then that can happen. That is, upgrade can happen after 360 days from the end of the review period. But the condition is resolution plan have to be successfully implemented. There should not be any further diminution in the fair value of the asset, and there should be no further request for extension of DCCO. Next, let's move on to the critical part, that is the income recognition. So for the projects that are under implementation and which are standard in nature, income can be recognized on accrual basis. But for the projects where DCCO is deferred but they still continue to be classified as standard, and if moratorium is given for interest and principal, then in those cases banks should recognize income only on cash basis, because there is a high risk in this project. Why? Because already DCCO got deferred. So understand, when it is standard it is accrual, but when it is standard but DCCO is deferred and they are enjoying the benefit of standard classification because of the reasons we discussed earlier, and if that account is enjoying a moratorium, then that income can be recognized only on cash basis. And if the account is NPA, then no further question, NPA IRAC norms have to be followed. Okay, now comes the other critical part which I had made so much of noise in the market, that is provisioning for the standard assets. See, when the bank is giving loan and when the project is under implementation, that is when the bank is giving loan for the projects and when the project is under implementation, as initially discussed, the project can be in two phases. One, it can be in constructional phase, and two, it can be in operational phase. That is, once the implementation is done, it comes out of constructional phase and gets into the operational phase. But here the provisioning is slightly unique. In the constructional phase, banks have to make 5% general provision for the existing exposures as well as fresh exposures. And when those projects move to operational phase, they can reduce the provision from 5% to 2.5% of the outstanding funding, and they can further reduce it down to 1% provided the net operating cash flow is positive, and that net operating cash flow of the borrower should cover the current repayment obligation for all the lenders, not just your bank, for all the lenders. This is condition 1. Condition 2 is total long-term debt of the project should have come down at least by 20% from the outstanding on the DCCO date. Okay, so look at here. Constructional phase, provision is 5%. In the operational phase, it can be brought down to 2.5%. Okay, so when the moment they get into operational phase, okay, 2.5%. But If they want to reduce it further by another 2% or say 1.5%, and if they want to take it down to 1%, then there should be positive operating cash flow which is sufficient to cover the repayment obligations not only to your bank but all the lenders. And number two, the total debt outstanding should have come down at least by 20% when compared with the debt position as on the DCCO, that is date of commencement of commercial operations. Next, let's talk about provisioning for DCCO deferred assets. That is, they have taken extension of DCCO. So if it is an infra based exposure and if the deferment is greater than 2 years, and if it is a non-infra and if deferment is greater than 1 year, in those cases banks have to make the standard asset provision of 5% plus an additional provision of 2.5%. Of course, this can be reversed on the commencement of commercial production or commercial operations. And the framework also talks about provisioning for delayed implementation of resolution plan. If a viable resolution plan is not implemented, then the additional provisions that are prescribed for delayed implementation have to be provided for. And of course, that can be reversed on successful implementation. Coming to chapter 4, which talks about creation and maintenance of database. That is, lenders have to maintain project specific data in electronic format that should be easily accessible and it should be maintained on continuous basis. If there are any change in project finance parameters, then they have to update within 15 days. For that, lenders should create a necessary system infrastructure within 3 months from the release of this direction. So what are those finance parameters? They are basically debtor profile, original project profile, change in DCCO due to endogenous, exogenous reasons, litigations, then credit event other than deferment of DCCO, and current specification of the project. So these are all the critical parameters, and if there is going to be any change, then that got to be updated within 15 days. Then the framework also prescribes regulatory return and disclosure. That is, all lending institutions who are going to take this project finance exposure, they have to submit return on quarterly basis within 15 days from the end of the quarter to the Department of Supervision with Reserve Bank of India. And lenders are also expected to make certain disclosures in the financial statements in their notes to accounts related to resolution plans. That is provided as an annexure in the framework itself. Then it also talks about the timelines for compliance, because we said no, there is 5% provision on standard assets during the construction phase. So how that should be done? 2% have to be provided with effect from 31/3/2025. This can be spread over 4 quarters of 2024-25. Then additional 1.5%, that is making it to 3.5%. This should be the position with effect from 31/3/2026, and this can be spread over 4 quarters. And additional 1.5%, making it to 5%, should be achieved before as on 31st March 2027, and this can be spread over 4 quarters. There is also penal consequence for non-compliance of the norms given in this framework, which could attract supervisory and enforcement action. So that's about this draft framework. It is still in its draft stage. Let's see what is going to be the final document. And if you wish to learn more, if you wish to get a copy of this document, I want you to comment RBI. Comment RBI. We'll be sharing this document link with you.